Tell us how you plan or are currently incorporating potential changes to fiscal policy coming from the Trump administration and the new Congress into your forecast and into your thinking about monetary policy.
So I'll broaden it: fiscal policy and structural reform. Structural reform for me could be just as important. So I'm looking at two things. I look at policies that either grow the workforce or improve productivity. Okay, some of the policies being discussed, regulatory review if it's done in a thoughtful way, potentially infrastructure spending, potentially tax reform, depending on the details, could have positive impacts, in my view, certainly on productivity. And I'm particularly zeroing in then on policies and structural policies that could grow the workforce. We need workforce growth in this country to grow GDP. And this is why I'm looking for improvement in education, vocational training, incentives for people to work longer.
Right.
And yes, immigration policy, either on the positive or negative side, is a central element of workforce growth.
So when you say positive or negative side, what's a potential negative kind of immigration policy?
Policies that might discourage growth in appropriate, understanding it's a sensitive issue in terms of appropriate immigration, could actually slow workforce growth. And here's my point. Over the last 20 years, immigrants and their children have made up over 50% of workforce growth in the United States. And our view at the Dallas Fed, that percentage will increase in the years ahead. Why is that? Because the workforce is aging. One of the big reasons participation is declining is demographic aging. So we need to look at several ways to grow the workforce if we're going to grow GDP.
I need to get back to monetary policy because there's another big issue out there, which is the balance sheet.
Yeah.
Do you have an expectation for when you think the Federal Reserve might reduce the balance sheet?
Yeah, so we've said so far publicly that we'll wait till we're well underway in terms of normalization before we start letting the balance sheet run off. I still think that's the case, but I think as the year goes on in 2017, we'll be actively discussing plans for addressing the balance sheet, but I still think that's probably the appropriate base case. We'll have to get a little bit further along, and then we should allow the balance sheet to run off again in a patient, gradual way, for me, that doesn't unduly affect the markets.
So if I'm getting you right, letting the balance sheet go down is not an issue for this year. It's a decision for this year as to when, but not an actual.
Depends on how much progress we make this year in normalization, in my view, and I think it's something we should be discussing. So I wouldn't put a time frame on it yet.
Right.
But I think as we make progress, I think it's important that we start taking the opportunity to actually let this balance sheet run off.
I want to get back to the economy and fiscal stimulus. There's two thoughts. One is that there is quite a bit of slack out there, and we can pump up the economy and we can get it going, and there's plenty of resources out there. Capacity utilization just at 75%. 96 million Americans are out of the workforce. Now only maybe 5 million of them or 6 million actually say they want jobs, but there is a pool of labor there. The other idea is that we're at or near full employment, and that kind of stimulus is going to potentially create inflation and force the Fed to raise rates more. Where do you stand in that debate?
So here's what I look at. I look at what's called, in the lingo, U6, which is unemployment plus marginally attached workers, discouraged workers and those working part-time who would like to work full-time.
Sure.
That number is right now, as we sit here today, 9.4%. The pre-recession low was a little above 8%. So I think there's some room there. The problem is, in a potential workforce of 160 million people, getting down to 8.1% is about 1 3/4, 2 million people. It's helpful, and I think we need to do things to try to get those people back into the workforce, but that alone isn't sufficient to substantially grow the workforce. So that tells me we're not at full employment yet. We still have some slack, but we're rapidly moving toward full employment. And I think as we grow this year, that amount of slack will continue to decline.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.